This section 5 and 6, it's about the declining balance method. So if we do some problems, might be a good idea. Declining balance method, it's accepted under tax rules, and it is accepted for GAAP. The most common one is double declining. Double declining means twice faster declining in compared to straight line. So if it is not double declining, it might be 150% declining, or let's say 125% declining. But double declining is the most common one. And double declining is the one that in tax rules is also used most of the time. So it's acceptable for tax, and you can use it the same thing for your book purposes, and it will be identical. For double declining, I mean, declining balance method, doesn't matter it's double or 150%. Declining balance method, it's the only one that you do not need the salvage value information calculation at the beginning. Every other type of depreciation methods, you need the salvage value information right away, but to calculate. But in this declining balance method, you do not need it. So here says in January of 2021, Apogee Corporation purchases for $101,700 a machine that is estimated will have a useful life of 3 years, important, and the residual value of $4,500, which we don't need it at this moment, as we just talked about it. Apogee uses double declining balance depreciation. Complete the table below. Okay, so we want to do it for 3 years. The only moment that you need the salvage value information or residual value information is just at the last year. Here, you see at the last year, this is the only moment after 3 years you need to remember that you never go below residual value. If your residual value is 0, then that's fine. Just go all the way to 0. If your residual value is 4,500, just make sure you stop at 4,500. Doesn't matter what your calculation says, but you just depreciate enough to just make sure that you stop at 4,500. Okay. In year 1 and 2, yes, you follow the calculation, but in year 3, doesn't matter what your calculation says. You just depreciate enough to stop at 4,500. Okay, just keep that in mind. The way your book says, it says 1 divided by 3. Normally, that's kind of, maybe you don't remember that. And the way I remember is always like this. I say 100% of my equipment, 100% of my equipment divided by useful life of 3 years. Okay. That gives me 33.33%. But because I want to do double declining, I will multiply it by 2. If I want to do 150% declining, then I will multiply by 1.5. If I want to do 125% declining, then I do 1.25. So why we use double declining, which is very common? Double declining means you use for a type of equipment that it's depreciating very fast. So here we go. Like real life example, I compared like Toyota with, let's say, I don't know, Cadillac. Toyota, it's good to use straight line because keeps the value for many years. But Cadillac will lose value very fast in year 1 and year 2. So if you have a Cadillac and you want to depreciate it, you use double declining. Makes more sense. If you have a Toyota to depreciate, then you use straight line, because looks like Toyota keeps the value in a straight line method much better compared to Cadillac. So here we go one more time. In order to do residual double declining, we say 100% of our equipment divided by useful life of, let's say in this case 3 years, gives us a percentage. That percentage times 2 gives us the double declining balance rate of depreciation, 66.66% in this example. So then we say, okay, how much is the original book value? Is the total cost of the equipment, including delivery and shipping and installation. That's $101,700 beginning book value, multiplied by the rate, and that gives us $67,800. So beginning book value is 101 times 66.66%. That gives us the depreciation expense. Accumulated depreciation will be 0 plus 67.8. Year-end book value will be 101 minus accumulated depreciation equals to 33,900. For year 2, we bring that 33,900 to the next line. That will be our beginning book value times 66% equals to 22,600 depreciation expense to be recognized. 22,600 plus last year accumulated depreciation of 67,000 gives us 90,000. 90,000 minus 90,000 minus beginning book value of 101. That gives us 11,300 end book value. 11,300 end book value. We push it to the next year. That will become our beginning of year 3. 11,300 times 66.66%. Let's see if I have that. Yes, here. 11,300 times 66.66% is 7,500, right? But the problem is, if I use that number, my year-end book value will not stand at 4,500. So I am going to ignore that. Even though the calculation says 6,500, 7,500, I'm gonna ignore it. I'm gonna say, okay, wait a moment. How much do I have? 11,300. How much do I want to have? 11,300 minus here. 11,300 minus 4,500 that I want to stop at my residual value gives me $6,800. That's all I need, and I can depreciate this year. So in year 3, I'm gonna just use $6,800 for my depreciation. And $6,800 plus 90,000 from previous year, accumulated depreciation will be 97,200, less original cost of 101,700. It ends up to be year-end book value of 4,500. Any question, please? No. Let's go to number 2. In January of 2021, Kaler Corporation purchased equipment machine for $151,500, for which it estimates a useful life of 3 years and a salvage value of $4,500. Kaler used 150% declining balance depreciation. Complete the table below. So for 150%, we just need to calculate the rate first. So we say 100% divided by 3 years. That gives us 33%. 33% times 1.5 time rate of depreciation, 150%, equals to 50% rate of depreciation. 50% multiplied by original cost gives us 75,750 for year one. And you put it right there. And for year two, because our book value ends up to be 75,750, you move that to the year two, and then 75,750 remaining balance times rate of 50% depreciation ends up to be 37,875 depreciation expense, which you add to the previous year of 75 accumulated depreciation ends up to be 113,000 accumulated depreciation. 113,000 minus original machine historical cost of 151, year-end book value ends up to be 37,875, which we put it in the year three. In year three, we multiply that by 50% again here. But that will become 18,938. So am I going to use 18,938? Looks like no. Why? Because I wanna, this is year three. That's all I'm gonna go. And I'm gonna stop at 4,500 residual value. So if I use that, my residual value will not be 4,500. So how much do I have to depreciate? Then I say, okay, what is left from the book value? Book value right now is 37,875 at the end of year two. Minus 4,500 that I want at the end of year three, that becomes 33,375 depreciation expense. So I'm gonna totally ignore this calculation using that regular math that we are doing. And I'm gonna just say, okay, 37,875 beginning book value for year three, minus 4,500 that I want to have at the end. Looks like I have to depreciate only 33,375 instead of whatever it's in here. Cool. Okay, let's do number three. On June of 2021, company purchased for 101,700 a machine which is estimated life of 4 years, scrap value 4,500. Company used the double declining balance depreciation, complete the table below. So this is 4 years useful life. So again, here we go 100% of equipment divided by 4 years. That gives us 25% straight line depreciation times 2. It will be 50% double declining balance depreciation rate. So we're going to use 50%. Very good. We pick up the beginning balance again, which is our cost, actual cost, times 50%. And the 50%. And here, just notice that you bought it in June. So in year one, you used in June, July, August, September, October, November, December. That's 7 months. Okay. So you cannot depreciate more than 7 months, obviously, right? So here we go. We can say, okay, that's 7 out of 12 and equals to 29,663. And that's what we're going to use as a depreciation expense, 29,663. Okay, 29,000 minus 101,000. Book value will be 72,000. 72,000 goes to year two, multiplied by 50% rate. ends up to be 36,000 depreciation expense. 36,000 plus 29,000 accumulated depreciation ends up to be 65,000 accumulated depreciation. 65,000 minus original cost of 1017. Book value at the end of the year ends up to be 36,000. We move it to the year 3. 36,000 times 50% rate becomes $18,000 depreciation. 18,000 plus 65,000 from last year. Accumulated depreciation becomes 83,000. 83,000 minus 101 ends up to be 18,000. 18,000 goes to year 4. So you create this in Excel. 18,000 times 50% rate becomes 9,000. 9,000 depreciation expense will be added to accumulated depreciation, and that goes into become to 92,000 total accumulated depreciation minus 101. Year-end book value is 9,400. So this is 1, 2, 3, 4. Already we did 4 years, right? And this is 4 years life. However, at the beginning of the year, we just used it 7 months. So you have to depreciate complete 12 months. So that's why we end up in being in year 5, doing the rest of the depreciation. So no choice, we go to year 5. In year 5, our book value is 9,400, but we want to stop at 4,500. So 9,400 minus 4,500 gives us only a permit to depreciate for $4,500 $4. No matter what the math says, there is no multiplied by 50% or anything. We go straight calculation, 9,000 beginning book value minus year-end final salvage value for year 5 is 4,500. That's, we have to stop there. So this is the only thing you can depreciate. And your accumulated depreciation will be 45 plus 92, ends up to be 97.2. 97.2 minus 101,700. The book value will be 4,500, and we stop at that moment. Okay, let's keep going. Number 4. In number 4, says on October 1st. Okay, so remember that's October. On October 1st of 2011, DAX Corporation purchases for $125,000 machine that estimates have a useful life of 5 years, residual 15,000. Okay, DAX is using 150% declining balance method. So how do we do it? So again, 100% of the car of the machine divided by useful life, in this case 5 years, gives us 20%. 100% divided by 5, 20%. 20% times 1.5, which is 150% declining, gives us 30% depreciation rate, and that's gonna be used for the rest of the calculation. So 125,000 times 30% times October, November, December, which is just 3 months out of 12 months, that will be 9,375 year 1 depreciation. The book value ends up to be 115. We push it to the second year, and then we multiply again. That will be 34,688. So 34,000 plus 9,000 will be accumulated depreciation of 44,000 minus 125 historical cost. Year-end book value will be 80,000. We push it to the year 3 and multiply it with 30% and by 30%, and then here we get 24,000 plus 44,000 accumulated depreciation. We have a new accumulated depreciation of 68,000 minus 125 original cost. the book value ends up 56,000. We push it to the year 4. We do the same thing again, multiply by 30% is 16,000. 16,000 plus accumulated depreciation last year, 68,000. The new balance ends up to be 85,000 minus 125,000 will be 39,659. We push it to year 5. And this is a 5 years life, right? Technically, it should stop at year 5, but because in year 1, where is it? Year 1, we bought it in October, so we have to probably go to year 6 also. So anyway, in year 5, we multiply that with 30%, gives us 11,898. 11,8 plus 85 is 97. 97 minus 125 gives us a book value of 27,000, which is still far away from our 15,000 residual value. And we have still 9 months of depreciation to recognize. So we go to year 6 anyway, 27,761. And this is the last year that we need to recognize whatever necessary. So 27,000 minus 15,000 ends up to be 12,761. And that's what we're going to use. So we're going to depreciate 12,761 no matter what. Then we add it to 97, it becomes 110. 110 minus 125 will be book value in year 6 at 15,000, and we stop at that moment. Are we good? Okay. So it says prepare the adjusting journal entry record for year 2003. That's the 2003 here or 13. The depreciation expense is 24,281. So debit depreciation expense, credit accumulated depreciation, and that's the journal entry for year 3. Let's do number 5. In number 5 says, on March of 2011, if a company purchased for $600,000 a machine that if estimates will have a useful life of 5 years and the residual value of 15. So you purchased it in March. Keep that in mind. We want to do double declining. Okay, so 100% of the equipment divided by 5 years useful life gives us 20% on the straight line. But because we want double declining, so we go with multiplying by 2 to have a faster depreciation rate of 40%. And we're going to use it again, the same method that I explained. So 600,000 times 40%. But because we bought it in March, so counting from March all the way to December, that's 10 months. So that's 10 out of 12 months of depreciation, which is $200,000 for year 1. So here we go, 200,000 year 1. And accumulated depreciation will be 0 plus 200, which is 200. And 200 accumulated depreciation minus historical cost of 600 gives us the book value of 400. We pick the book value, we put it in year 2. Again, as you see, double declining, we don't use the residual value in our calculation at the beginning. So keep that in mind. This is the only method, double declining, only method that you do not use your residual value into your calculation at the beginning of creating your schedule of depreciation. So here 400,000 times 40% rate, that's a depreciation of 160. 160 plus 200, it's 360 accumulated depreciation minus book value, minus cost of 600,000 total cost gives us a book value of 240. Take the 240 to year 3, multiply by 40% again. That gives us $96,000 depreciation expense plus previous accumulated depreciation of 360 gives us 456,000 balance. Accumulated depreciation less cost of 600,000 gives us book value of 144 in our balance sheet. 144, we take it to the year 4, multiply by 40%, will be 57,000 plus 456 accumulated depreciation of last year. So accumulated depreciation goes to 513. 513 minus 600 gives us 86,000 book value. 86,000 book value goes to year 5. And this is normally when we stop. This is our last year. But because we bought it in March again, don't forget that tricky part. It's easy to not look at that. So if it's March 1st, so looks like you used it only for 10 months. So you have another 3 months, you have to go to year 6. So in year 5, we multiply by 40%. It gives us 34,000 plus 513. From last year, it will become 548. 548 minus 600 is 51,840. We take it to year 6, and this is last year. We have just 3 months of depreciation for year 6, technically, to recognize. So that means we have to stop at residual value. This is where the residual value becomes an important number. So we say, okay, the original, the year 6 book value is 51,840 minus 15,000 that I want to stop at. So 51,840 minus 15,000 gives us 36,840 to depreciate. And if you look at the year 6, even though you have just 3 months of depreciation in year 6, but look at it, your depreciation expense is more than 2005, which was only 34,000. But no matter what, you need to stop at that moment. There's no other choice. So we're gonna recognize 36,000 depreciation. We add it to the accumulated depreciation of 548. Accumulated depreciation ends up to be 585 minus book value, original cost. The book value stands at 15,000. And the depreciation expense will be debited for year 1, 200,000, and accumulated depreciation will be credited. Okay, so we have one more section to go. This section 6 is not that much common for depreciation in a business environment, but it is a method that it is available. Nowadays, this sum of the years digit method is not in financial accounting books anymore because it's not that much common. Mostly in financial accounting books that you probably took already, it's either double declining or straight line or units of production method, not sum of the years. Okay, but how is it anyway? Oh, by the way, sum of the years is not acceptable for tax purposes either. So it's kind of very unique just as a method for GAAP, but not in taxes. For taxes, you can use straight line, same as GAAP. You can use double declining, same as GAAP. You can use 150% declining, same as GAAP. But sum of the years is not acceptable for taxes. Same as unit of production is not acceptable for taxes either. So on January 1st of 2011, company purchase of 101,700, a machine that company estimates has a useful life of 3 years and the salvage value of 4,500. Company used the sum of the years digit depreciation. Complete the table below. Okay, in order to do this, there are two ways to calculate. Either use the formula or use the easier method that you can kind of always remember it. Here is the other method that you can remember. You say this is 3 years, so 1 plus 2 plus 3 years. So year 1 plus year 2 plus year 3 equals to what, 6? You see? So that is the same thing. So either you're going to use this formula, which is n times n plus 1 divided by 2. And the answer is 6. If you like to do it this way, it's also good. Either way is fine. So now that you need what is your denominator, so you just need to say, okay, my original cost is 101,700 minus residual value. Remember, residual value, you always need it at the beginning. The only method that residual value, you don't need it in the beginning, is double declining. Other than that, residual value is always needed at the beginning. Okay, so 101,700 minus 4,500 residual value gives us $97,200 depreciable base. That's all we're going to depreciate, 97,200. Okay, so here we go. 97,200 depreciable base times 3 out of 6. We start from the last year, which is 3 years. So 3 out of 6. The denominator is 6. And so 3 out of 6, that gives us $48,600 of depreciation. Very good. For year 2, we say, okay, depreciable base is 97,200 times 2 out of 6, because this is year 2, so 2 out of 6. That's 32,000. For year 3, we say, okay, depreciable base is 97,200 times 1 out of 6. And that gives us 16,200. So the only thing you need to calculate at the beginning is your denominator. As long as you have your denominator right, then 3 out of 6, 2 out of 6, 1 out of 6, and that will be your depreciation for year 1, 2, and 3. So 101 minus 48 depreciation gives us accumulated depreciation of 48. Book value is 53. And then at the end of year 2, book value is 53, as you see. The depreciation will be calculated in here separately. So here I have the depreciation already. So I plug it in depreciation expense, plus the accumulated depreciation of last year will be 81,000. 81,000 plus original cost of 101 give me year end of 20,000, and beginning book value for year 3 will be 20,700. Based on my calculation here, again, 16,200, I pick it up, copy it in here, and that's 16,200 minus plus 81,000 accumulated depreciation becomes 97,000 accumulated depreciation at year 3, minus the book value of 101 gives me 4,500 year-end book value, which happens to be exactly what I want to be. Makes sense, right? Questions, please? Okay, so for second problem, on January 1st, again, so it's very important, you bought it at the beginning. Kyler Corporation purchases 151,500, a machine which it estimates a useful life of 4 years and residual value 4,500. Use sum of the year digit method. Complete the table below. So first I need to do the math again. So this is 4 years. So I'm gonna do, first of all, what is my depreciable base? My depreciable base is original cost minus estimated useful estimated residual value, gives me $147,000 depreciable base. As long as I know what is depreciable base, then I need to calculate denominator. To calculate the denominator, I can use the formula or, and I say 1 plus 2 plus 3 plus 4 equals 10. There you go, 10. Okay. So now I know my denominator. Then I'm gonna go ahead and start calculating a little bit before I fill up my table. So 147 times 4 out of 10 for year 1. 147 times 3 out of 10 for year 2. 147 times 2 out of 10 for year 3. 147 times 1 out of 10. That's year 4. And remember, I bought it in January 1st, so there is nothing else to be worried about. So then I will fill up my table. So my depreciations for every year is already calculated, as you see. When you fill up the table, and accumulated depreciation will be constantly updated year after year. So the year 4, the accumulated depreciation minus the book value, minus the historical cost, original cost, gives us 4,500 book value at the end, and we stop at that moment. You might keep the equipment for many more years, but that's how it looks like in your balance sheet, showing $4,500 book value. If one day you sell it above 4,500, you will have a gain on sale of used equipment. If you sell below 4,500, then you will have loss on sale of equipment. Do you know what is the journal entry? If we have a, let's say, loss, you sell it for, let's say, 3,000. Anyone knows the journal entry? Do you want me to show you? Everyone is quiet. Are you there?
Yes, please show us. Thank you.
Sure. Okay. Okay, so let's go down here. Say, let's assume that we sell the, let's say machine. Let's machine after using it for 6 years. So we used this machine for 6 years. Yes, the useful life was 4, but we sold it after 6 years. So that's good. So the journal entry for how much? For let's say $3,000. Very good. So we sold it. Journal entries is, here we go. First we got cash. That's easy, right? So I like that. So cash We got cash. So let's go a little bit to the, and here is a debit. We got $3,000. I like that. Okay. But I know that I need to close two T accounts. I need to close the equipment T account, and I need to close the accumulated depreciation dash equipment T account. So in order to close accumulated depreciation has a credit balance. Okay. In order to close it, you need to do debit. Opposite. Equipment has a debit balance. It's an asset. In order to close it, you need to do opposite, which is credit. So because we are doing all the debits, so let's do debit first. So here we go accumulated depreciation dash equipment. And we call that $147,300, right? Coming from here, total accumulated depreciation. Okay, that's fine. But also we need to close the accumulated depreciation has a credit balance, so we have to debit that. So let me push this a little bit to here so it matches better. So, okay. So debit, and then equipment. You have to do credit. So how much? The equipment on the credit side will be that original balance, 151,500. Okay. Okay, good. Then, is this equal? I don't think so. So let's do the math. Where is my calculator? Here. So it's a plug-in. So 151,500 original cost on the credit side to close, minus 147,300 minus 3,000 equals 1,200. What did I say? 147. Here is 147. Okay, here I made a mistake here. Okay, give me a second. This is 0. This comes from here. You see that? Right there. Okay, let's do the calculation one more time. Okay. So on the credit side, I have 151,500 original cost, which is good. On the debit side, I have minus 3,000 minus 147,000. Okay, that's $1,500 shortage on the debit side. Okay, so because my book value is 4,500 and I sold it for 3,000, $1,500 is my loss on sale of equipment because my sold price was below my book value. And I just did the math. So my math is matching with my explanation that I said book value is 45. I sold it for 3,000. So obviously I have $1,500 loss. So I am good. So I'm going to say loss on sale of equipment. And here we go. That's 1,500. Done. That's a journal entry when you sell it. So you close the equipment, close the accumulated depreciation, record your cash, and this is a plug it in. You plug in the number. If you need to plug it on the debit side, plug it at the debit side, and that will be a loss. And makes sense because normal balance for expense or loss is debit, which is loss. If it is on the credit side plugin, obviously you have a gain because it looks like you sold. If you sell it more than 4,500, you will have a gain. In this example, it's a loss. Okay. Let's move on. One more. On June 1st of, okay, this is June. Keep that in mind. On June 1st, company purchased for 101,700. Useful life 3 years. Residual value 4,500, and we want to use SYD. Okay, so in order to do SYD, first you calculate very first thing that always you do for every type of depreciation besides double declining. You say, okay, my original cost is whatever it is minus residual value, and which is estimated, gives you the depreciable base. As long as you have that, then everything is fine. Then you, next step, you calculate your denominator, which is 3 years. So your 3 years denominator ends up to be number 6. That's what you're going to use. Okay. Now, for year 2001, we bought it in June, July, August, September, October, November, December. That's 7 months. So in year 2001, you're going to depreciate only for 7 months out of 12 months. So $97,000 depreciable base times 3 out of 6. The 6 is the denominator, and we start from the useful life of 3 years. So we do 3 out of 6, which is 48,000. In year 2 is again 97,200 depreciable base times 2 out of 6. In year 3 will be 97,200 times 1 out of 6. But year 1 is just 7 months. So 7 out of 12 times 48,600 gives us 28,350, and that's what we're gonna recognize in year 1, 28,350. In year 2, we have 48,000, right? Which 5 months still is left to take care of. So we take care of that 5 out of 12 times 48,000 that it's remaining from year 1, ends up to be 20,250. Very good. But then we go to year 2, 5 months is already taken from the previous year. So we have 7 months left. So year 2 depreciation should be 32,400, but we multiply that with 7 out of 12 calculation remaining for year 2. And that gives us 18,900. And then we add them up, ends up to be 39,150. So you see this sum of the year digit it's a little bit complicated, and you can kind of see why is not a favorable common type of depreciation used in businesses, because it is adding to the complication of everything else that we already have in our life. Anyway, year 3, in year 3 already I have 5 months left of year 2 to recognize. Okay, so 5 out of 12 times 32,000, that gives us 13,500. Okay, 5 months is gone. The other 7 months out of 12 times 16,300 for year 3, and that gives us total of 13,500 plus 9,400, 22,950 total depreciation expense for year 3. In year 4, now we have just anything left from year 3. From year 3, we have 5 months left. So 5 out of 12 times year 3 depreciation left over, it is 6,750. And that's all it is. So add them up, it's 6,750 plus nothing in here. So for year 3, as you see, I'm dividing my depreciation to 7 out of 12 for year 3 and 5 out of 12 for year 4. In year 2, again, my depreciation is in 2 pieces. 7 out of 12 of year 2, and then the rest will be the next year in year 3, 5 out of 12. Same thing in year 1. In year 1, again, it's 7 out of 12 for 48,600, and the remaining 5 months will be in next year, in year 2. So it's kind of, you see, 2 years, 2 years, and 2 years. So it's separated in 2 years because we purchased this in June 1st. So you need to be a little bit careful on this, okay? It's very easy to make a mistake. For number 4, it says on October 1st of 2001, DAX Corporation purchased for $125,000 machine. Estimated useful life is 4 years, salvage value 5,000. Use sum of the year digit depreciation, complete the table below. Okay, we need to know what is our depreciable base again, just like every other depreciation besides double declining. So that's 125,000 minus 5,000 gives us depreciable base of 120. Then I need to know the denominator. So denominator is for 4 years. So 1 plus 2 plus 3 plus 4 ends up to be 10. Or use this formula. Now I know that the denominator, so all I need just to have an Excel type of thing and start calculating. So year 1 is my depreciable base of 120 times 4 months. When did we? October, November, December. Yeah, October, November, December. So 3 months. And then 9 months will be the next time. Okay. So depreciable base times, we know that denominator is 10. And this is first year. So we start from the useful life of 4. So 4 out of 10. And then we use the same thing, the 120 times 3 out of 10. And then 120 times 2 out of 10. And then 120 times 1 out of 10. Now we have all these numbers ready. So 48,000 times 3 out of 12 for year 1, that's 12,000. And that's all we're going to depreciate for 3 months. We push the remaining 9 months to year 2. And we say, okay, 9 out of 12 times 48,000, that will be 36,000. However, for year 2, we have another 3 months left to recognize. So 3 out of 12 times 36,000, that gives us 9,000. 9 plus 36 is 45. But from year 2, 9 months is left. So we go to year 3. And in year 3, we say 9 out of 12 times 36 remaining. That's 27,000. But that's 9 months. The other 3 months will be 3 out of 12 times 24,000 for year 3. And then we add them up. 27 plus 6 is 33. That's the depreciation expense for third year. But that's not good enough because in year 3, we just did 3 months. So we push the rest to year 4 and we calculate 9 out of 12 times 24,000. That gives us $18,000. but that's just 9 months. So we have another 3 months to go. So 3 out of 12 times year 4 calculation of 12,000. So 3 out of 12 times 12,000, that's 30,000. 3 plus 18 is 21. But in year 4, we just did 3 months, okay? So no choice, we go to year 5. And we finish the remaining 9 months over there. So 9 out of 12 times 12,000, that's $9,000. And that's gonna be total depreciation for year 5, 9,000. And then we create our table as we did before. And as you see, we stop at the residual value. Questions, please? Okay. Let's do, I believe we have one more. Yeah. And here says in number 4 says, what is the journal entry? The journal entry is already clear to everyone, right? Depreciation expense will be debit for the year and accumulated depreciation will be credit. Okay, let's do number 5. Oh, okay, this number 5 is too long, so we come back to. Okay, on March 1st of, okay, remember that, March 1st, 2000, let's say 11, FE company purchased for $600,000 machine. Estimated life is 5 years. Residual value is estimated for 15,000. Use sum of the year digit depreciation. Okay, 2 things again you need to do, just like the other ones. Calculate your depreciable base. 600,000 minus residual value gives us 585 depreciable base, which we're gonna use constantly. Sum of the year denominator is, this is 5 years, so 1 plus 2 plus 3 plus 4 plus 5 equals 15. Okay, so 585, the depreciable base times 5 out of 15 times 4 out of 15, 3 out of 15, 2 out of 15, 1 out of 15. And we got all those dollar amounts. Okay. Now, in year 1, we have $195,000 times the 10 out of 10 months out of 12. This is 195, right? And we bought it in March. So March through December is 10 months. So yes, I know we have to depreciate 195 for year 1, but the point is in year 1 is just 10 months. So we have to calculate a little bit more. 10 months out of 12 months for year 1, and that will be $162,500 in year 1. In year 2, we already have 2 months left from year 1. So let's take care of that. So 2 out of 12 for year 2. You see, in like straight line depreciation or double declining depreciation, you never do this type of thing. But in some of the years depreciation, you have to do it. That means you have to remember to bring whatever is left over from year 1 and then do the remaining from year 2. So it's that's where it's gonna get complicated. So be careful when you are doing your certification exam. So 195,000, but 2 months is left, whatever it is, plus from year 2, I have $156,000 to depreciate, but it's just 10 months left from year 2 to do that. So 156 times 10 out of 12, whatever it is, add them up. It is 162,500 in year 2 for the depreciation. Happens to be like year 1. That's fine. This 156,000 is just 10 months. So go to year 3, take care of the remaining 2 months in year 3, calculate that. And in year 3, I have 117,000 to depreciate. So I'm going to take care of that one for the remaining of 10 months. And ends up to be 123,500 for year 3 depreciation, which is right there. In year 4, I have 2 months left from year 3. I'm going to take care of that calculation. Plus, in year 4, here, 1, 2, 3, 4, I have 78,000 to depreciate. I'm going to do that, but just for 10 months. Because 2 months already I did it in here. So 10 months, add them. It's 84,500 that goes into year 4 depreciation. So you see there are 2 sets of calculation. First, you calculate what is the annual depreciation, and then you calculate what would be your depreciation to recognize based on how many months you used it. So you go to year 5, you have 2 months of year 4 left. You're going to take care of that. And then you know, for annual depreciation, year 5 is 39,000. So you're going to recognize 10 months remaining of that. 39,000 times 10 out of 12, add them. Total depreciation is 45,500, and you put it in year 5. But this is because we bought it in, let's say, March. So there is 2 months left. 2 months in 2000, go to year 6. 2 months of 39,000 that is left from the above calculation, and that will be $6,500 to recognize in year 6 for that 2 months of usage of the equipment. And it says, what is the journal entry anyway for, let's say, year 1? So year 1, the depreciation expense is 162.5, and that's the journal entry. I think that's it, right? Yes. Okay. The reason we covered all these books in this class, because if you like to get your certificate of bookkeeper designation, you have 4 exams to go over, and these books are part of the exam. So that's why we try to cover as many as things we can. Also in bookkeeping class, accounting 10, we cover 4 books over there. So combine here accounting 10 and accounting 104B, we cover 4 books in accounting 10 and 3 books in accounting 104B. That will be 7 books, which is good enough to pass your certification exam. There is one more exam in certification which you need to buy that book separately yourself and study and take the exam, which is internal control. It's a tiny book, black color, and if you want to go to become certified, so that's the only book you need to study at home. Then you can take your exam. I suggest become a member of AIPB, which is very good thing to do. You get, let's say, I believe twice a month, very good type of email that is very informative, gives you very good tips in accounting and bookkeeping, and also you will have a hotline available to you as a member in case you want to ask a question regarding a specific journal entry or action that you need to do in your office. And also take the test and become that certified bookkeeper. So you earn that designation, you need to show 2 years of experience, obviously, don't forget that, but try to get the ball rolling so you can become certified bookkeeper, and that will add to your will be added to your resume, and it will create more opportunities for you.
Yeah, Professor, quick question on that.
Mhm.
Yeah, the work experience, 2 years of work experience, does it have to be specifically in bookkeeping, or could it be just, say, payroll related only? Do you know
no,
the
that's it.
criteria of that?
Yeah, payroll is good. Payroll, bookkeeping, accounts receivable, accounts
Okay.
payable.
So anything that, you know, the topics are covered in. So if you're doing that specific job, you can still go sit for the test.
Yeah, you can sit for the test today. Don't worry about sitting for the test. Experience is needed after you pass everything. After you pass everything, you have, I believe, 2 years to complete your experience. So you can pass the designation examination, put it in your resume that I passed my designation examination,
Okay.
and I am just waiting to get that 2 years of experience. If you have it already, you just fill out the form, sign it and send it to them, say, hey, I have the experience already. If you don't, that's still fine. Get a job, work for 2 years, get the experience, and then after 2 years, fill out the, keep your membership. Obviously, you need to stay as a member, and then after 2 years, you will earn. You submit your experience, and then you earn your designation. The moment you earn your designation, you need to, just like me, like I'm a CPA, or if you are enrolled agent, you have to have the continued education to keep your designation on an annual basis. And in order to get the continued education later on, if you become a designated bookkeeper, certified bookkeeper, I suggest go to, this is the easy, informative, and free. So open an account with cpaacademy.org. You see, and this is my account, and I have all my CPE credits, continued education credits in here. So I can view all those details, and I can upload it as an Excel, and I can go and print every single certificate, for example. And also, let's say for the next few days, if I like to earn more hours that I need for my CPA license, so I can choose any of those items, classes that are there. Most of the time are free. Maybe once in a while is if you need ethics or something, you might need to pay for it. But even for ethics, when I look carefully, I will see if there is a free ethics class webinar. I will go through that, and normally I don't pay even for ethics. There are sometimes regulatory for CPA classes. There are some regulatory classes that I need to take. I might need to pay for those. But that's once in a while, every 2 years or so. So every 4 years.
Wow, thank you. That was really helpful.
Yeah, so you don't have any problem. And there are so many good stuff here that I say, oh, I like to learn this, or, oh, I like to learn this one, like international tax. Oh, I like that. So you can choose what you like. Sometimes there's good stuff here that is really, really interesting. Like what is pass-through entity? Oh, I like to learn that, let's say. Like S corporation or partnership, it's a pass-through entity. 401k, if I like to learn that. So go, oh, 131 exchange. I really like to learn that. So here we go. I took that class before. So it's good stuff here, and there are expert people that they come and they know about that subject. And normally that's what they do all day long. And the reason you get this type of things free is let's say one day you want to do 1031 exchange, and even though you know what it is, but you have a client that wants to do 1031 exchange, and the client is asking you, so you can take the client and contact these professionals here, and that you took the webinar, and you kind of do the referral. So you referred your client to these professionals, and you can just get a referral fee. Make sense? So you keep your client happy, and you take care of your client, and also you get a referral fee from these people who take care of your client. And you know, these people are very familiar with 1031 exchange. They do it all day long. So they take care of your client professionally, and you get a fee. Why not? Okay. Okay, that's about it. Any other question?
No, that's good stuff, though. Thank you for sharing that.
Sure. Keep this in mind. Anytime you become certified or licensed, EA licensed, CPA licensed, certified bookkeeper, you need continued professional education, and this is a very good source. Okay, have a good day. Bye-bye. See you next week.
Thank you.
You're welcome.